Hello, everyone. This is Paul Forchione. Thank you for attending today's webinar, where I will be discussing adjusting options positions. Just so you all know, this webinar will be recorded. It will be available on the OptionVue.com website, where you can easily locate it under archived webinars. So you may want to, in the future, go back and review it a second time in the event some of the material that I'm going over is material that you would like to listen to a second time. My intention today is to, first of all, discuss what adjusting is all about, give you several examples in a variety of markets, and explain that not all options positions should even be adjusted, only certain types of options positions. And what I mean by that is there are two basic types of options spreads. There are directional options positions, and there are volatility-based options positions. It is the latter category, the volatility-based options spreads, that really are, in my mind, candidates for potential adjustments. Now, what do I mean by adjustments? The simple answer is you would want to adjust an options position if its Greek variables of delta and Vega change to levels that you're not comfortable with, or in other words, the idea of adjusting or modifying your position is to reduce your exposure to losing money if the market or implied volatility moves unfavorably. We're going to give you a lot of examples, so let's go right into my OptionVue positions. So let's see here. I'm going to share my desktop. And I am showing you presently the quotes display from the OptionVue 7 software. What I'd like to start with is the ZB, which is the 30-year government treasury bond market. I do have real-time quotes, so you will see right now that the September contract is 134.14. It's up 16 seconds today. Let's take a look at the matrix for the T-bond options. And let's start with a volatility-based trade that we're going to look at from an adjustment perspective. So let's start with a butterfly trade. A butterfly trade. Well, you can see we've got several different options here. And I'm going to go to the September options that expire 40 calendar days from today. And what I'm going to do is create the following butterfly. With the September futures at 134 and 15 seconds, which is about 134 and a half, I'm going to create a 135 iron butterfly. And an iron butterfly, by definition, is a short strangle at a particular strike price. I'm choosing the at-the-money strike, the 135 strikes, puts and calls. And then I'm going to go 5 points further away out of the money for insurance on each side. So I would be purchasing the 130 put and purchasing the 140 call. So what we really have, you can describe this as a short at-the-money straddle in combination with a long out-of-the-money strangle. But you can also look at it as a credit call spread, short the 135 call, long the 140 call, and a credit put spread, short the 135 put, long the 130 put. Oh, and by the way, I should also mention that what I will do is periodically pause, go back and see if there are any questions that you folks may have. So you can feel free to type in questions that you have into the chat window. Okay, so this is an at-the-money iron butterfly. You can see underneath the display of the puts and calls is the summary section where it shows the net delta on this trade is 3.83, essentially 4 deltas positive. We've got theta, or positive time decay, of $18.10 a day, and we have a Vega of minus 147. A Vega of minus 147, which means that this position is exposed to changes of implied volatility to the tune of $147 for each 1 percentage point change in implied volatility. Now, what that really means, if I were to pull up the price chart and show you the blue implied volatility line for today, it shows implied volatility on Treasury bond options as a composite reading is 9.2%. The actual reading is at the bottom of the screen, 9.2%. So the Vega factor on this spread being minus 147 means that we benefit by $147 if implied volatility drops from 9.2 to 8.2%. It also means that we lose $147 if implied volatility increases from 9.2 to 10.2%. So clearly, there is a significant degree of money to be made or lost just from a change of implied volatility. When I click the Analyze button and change the colors so it's in red, and I will change the scaling to be half a point or 16/30 seconds on the x-axis, here's what this trade looks like. I've got 5 performance curves. I'm highlighting today's T+0 line so that you can see how this trade will perform today as the market moves up, as the market moves down, by looking at the P&L line underneath. Since we are 4 deltas long starting out, as the market rallies, the delta which is long gets close to neutral, and if it continues to rally, the deltas become increasingly short, which is not a good thing because you don't want short deltas when the market is rallying. Likewise, as the market declines, the deltas tend to get longer. So this butterfly trade is clearly a trade that performs the best if the market doesn't move significantly in either direction and if time goes by. Because as time goes by, the theta, which is positive, becomes increasingly positive in your favor, and that's where your profits are coming from to a great degree. If, in addition, you have a favorable move of implied volatility, which in this case means a decrease of implied volatility, and we can put that in here. We can assume there's a decrease of 1 percentage point. That will add to the profits as well. So that's generally how a at-the-money butterfly will perform. So now the question is, what happens if this market does make a significant move in one direction or the other? Let's say that the market drops down right after you put this trade on by 2 full points. Goes from 134.13 to 132.13. Well, this is telling us the spread, the butterfly in its entirety, would lose about $266 independent of what might happen to implied volatility. If all we want to do is get this trade back on track because we want to avoid larger losses if the market continues to trend down, one of the things you could do is adjust this trade, modify this trade back to delta neutral. You'll see the deltas grew from +4, which is close to neutral, to +20 or 21 with a 2-point drop in the market. So how do we get back to delta neutral? The +20 deltas, we want to get closer to 0, which means we want to acquire 20 negative deltas. The simple thing to do is to just remember the concept that you adjust in the direction that the underlying commodity is moving. The commodity is moving down in this case, so we want to acquire negative deltas, negative 20 deltas. How do we acquire negative 20 deltas? The simple way is to do a credit call spread, a bear call spread. We could purchase to close a 135 call that we sold, and we could sell to open a 133 call. So we would be selling the 133 slightly out of the money call when the market drops down to 132.5, and purchase to close the 135 call that we previously sold, and then we would have a position that would be 3 deltas positive at this level of 132.13. That would get us closer to neutral. If we wanted to get a little delta short, we would instead sell the 132 call to open and buy the 135 call to close, and now we would be 6 deltas negative with the position. But you will notice that when we did this, not only do we adjust our deltas, but we do have an impact on our Vega factor. The Vega factor with this selling of the 132 call to open, buying the 135 call to close, the Vega is minus 115. The Vega factor on the original position was minus 146, and here at 132.35 it was 91 negative. Now we are 115 negative. So we really do have a negative Vega still, but it is not quite as large as it was starting out. Now, this would be a simple adjustment to accommodate the fact that the market is moving down. What if we also wanted to make an adjustment that took into account volatility? If we did not want to have this negative Vega factor at the 132 level of negative 115, but we wanted to get that much less negative because we perceive that implied volatility will rise as the bond market falls, then we'd want to do a different type of an adjustment. Instead of doing a simple credit call spread, we would want to make an adjustment that provides negative deltas and positive Vega. Negative deltas and positive Vega. The type of a spread that achieves that would be what's called a diagonal calendar put spread. A diagonal calendar put spread. Well, if the market drops down to 132.5, then what if we were to purchase in the month of October, the next month out, what if we were to purchase a 135 call, which actually is a nice hedge against our short 135 put, which is now in the money with the market dropping. So if we buy an October 135 put, and if we were to sell, let's say that we sell this 130 put that we previously bought in September, we close that. That means we're selling a September 130 put, buying an October 135 put. And if we now look at this overall position, and the market has dropped down to this level, now we are 27 deltas short. We've really acquired too many negative deltas, but we also have reduced our negative Vega to only minus 58. Let's try a different adjustment. Let's put that 130 put back, and instead of purchasing the 135 put, let's look at purchasing the 138 put, and let's sell, let's try another one of the 135 puts. This is still a diagonal calendar put spread, and let's take a look at what that looks like. Now with the market down here, we are much closer to neutral. We still have a quite large negative Vega factor, however. That really didn't help us with our volatility. So what is that telling us? It's telling us that we need to choose our strikes a little bit better. What if we were to purchase an October 132 put, which is an at-the-money put, with the market down at that level, which is going to have a delta of close to 50 actually. And then what if we were to sell this 130 put that we had originally purchased? Now let's take a look at it. As the market drops down to this level, we are 5 deltas negative, and we've reduced our Vega to only minus 18. So this really does accomplish what we want. We become less sensitive to Vega. We still have positive time decay, and we have changed our delta bias to being slightly delta negative so that the continued passage of time can lead to profits on the trade that will exceed the loss that we may have seen when the market dropped 2 points. When the market dropped 2 points, we saw that we lost $250. Now we have an opportunity to make that back with the passage of time, and we're not vulnerable to a continuation of the move down. So you can do a credit call spread to simply adjust the deltas, or you can do a diagonal calendar put spread to adjust both the deltas and the volatility exposure. Let's see here. Let me check and see if there are any questions. Okay. Are you losing money on those adjustments by selling the existing position? Well, in the case of doing the diagonal calendar put spread, where we are purchasing a 132 put, that's a new position. When we are selling the 130 put, which was an existing long position, we're going to be locking in a profit on that 130 put, because with the market dropping, that long position will gain in value. Nevertheless, when you make an adjustment, you're going to make the adjustment based upon what you are attempting to achieve in the way of deltas and Vega. Whether or not you happen to close an existing position for a loss is not really that important, because you're simply wanting to recalibrate your exposure from this point forward. And as far as the clearing firm is concerned that's handling your account, both the realized and unrealized profits and losses are all part of the mix when they compute your account equity, your account value. So you never really want to be influenced by, well, I want to leave the positions that have a big profit, or I should say, or not close the positions that have a loss, because closing positions that have a loss and re-hedging your position so that you are now positioned the way you desire from a delta and volatility standpoint is really the most important thing. Okay, so this is an example of a butterfly trade that is an adjustable type of a position. A butterfly trade is a volatility trade, because as I showed you with the original position, regardless of which timeline you click on, the Vega factor is a rather large number. It's a large number in relation to the theta factor. So it's a volatility, implied volatility-based trade that is a viable candidate for adjustments. Let me show you a different market and a different trade. Let's go to the gold market. Okay, gold is closed. Nevertheless, it is trading in the aftermarket, so we can still look at this one. And let's take a look at a simple calendar spread in the gold market. I'm going to work with September and October options, September and October. And let's take a look at selling the 1300 call in September and purchasing the very same strike in October, the 1300 call. The September and October options are all based on October futures, which are at 1282. So I'm putting on a calendar spread that's slightly out of the money. It has a slightly positive delta, just 2 deltas positive, with positive beta and positive Vega. Here's what the trade looks like. And I'll change the colors so they're in red, easier to see. And we'll change the scaling to 15 points on the x-axis. So here we are. This is a typical graph for a calendar spread where the expiration graph has its peak at the 1300 level, which is the strikes that we've chosen. However, you can see I've got 4 timelines, and as time goes by, the trade tends to make money because of positive time decay. The deltas also tend to get slightly more positive at this current level with the passage of time. The trade is very insensitive to short-term market direction. However, you can see there's a little more vulnerability on the downside. The trade would tend to lose $120 right away if we had a $30 drop in gold right after putting it on. In 15 days, the trade would have a smaller loss. But in either case, the delta is getting increasingly positive. That's the nature of volatility-based trades that earn positive time decay. Namely, the deltas get increasingly positive on the downside, and they get increasingly negative on the upside. So in this case, if you felt that, well, this is a small loss, but I really don't want to lose any more as the market continues down, rather than just closing the entire position, you can adjust it. And similar to what we did with the bond butterfly, to obtain negative deltas, we can do a simple credit or bear call spread. When we go back to the matrix and we take a look at our front month of September, we sold the 1300 call. So if we were to buy that one back to close, and if we were to sell, let's say, a 1285 call in its place, that means we've done a credit call spread. We're selling the 1285 call, buying the 1300 call. We happen to be buying the 1300 call at a profit because it will have shrunk in price when the market dropped, but that's not as important as the spread itself that we are doing. Because when you look at the entire position, now we have gotten our position back to very close to delta neutral. It's only 1.66 deltas negative at this level, and the trade will, with the passage of time, earn profits in excess of the small loss that we would have incurred with that sudden drop. And the market is still going to earn profits as the market moves lower, but if it were to continue lower, we could make another adjustment if we wish. So a credit call spread to simply obtain the negative deltas that we want is a viable adjustment strategy. Now, what if the market were to do the opposite? What if the market were to really rally very quickly? If it rallies very quickly, then we're sort of outrunning the sweet spot, which is, further down here. But if it rallies up to this level and now we're 3 deltas negative, not that we've lost a lot of money, but you can see that we're going to lose money if it continues to rally. So how can we obtain 3 positive deltas and also receive additional positive time decay? Well, we can do a credit put spread. We did this trade with calls, but we could add a credit put spread where if the market rallies up to that 1350 level, what if we were to, or not 1350, what was it? 1357. What if we were to sell an out-of-the-money 1300 put and purchase an out-of-the-money 1290 put. That put spread by itself gives positive deltas, gives a little bit of positive time decay, and we get back to basically delta neutral with a little bit of additional positive beta so that the passage of time will allow us to earn more money. You'll see that because we're in a dynamic environment, the deltas, which are neutral right now, in 15 days become a little bit delta short. In 29 days, they become 5 deltas short. So you do need to monitor your position every day so that you can see what your Greek variables with respect to delta, beta, and vega are. So a credit call spread is an adjustment to obtain negative deltas on the downside. A credit put spread is an adjustment to obtain positive deltas on the upside. Very straightforward. So doing these types of vertical credit spreads is the best way to adjust deltas. And as I showed you with the bond butterfly, doing diagonal calendar spreads is a viable strategy for a delta adjustment in combination with a volatility adjustment. Okay. Let's see if there are some additional questions. I don't see any yet. Let's switch to a different market. Let's go to the E-mini S&P. And I'm going to show you another strategy that is a viable candidate for modifications with adjustments, namely a strangle swap, a strangle swap. Well, in case you don't know what a strangle swap is, it happens to be, and here's the example, I will sell a strangle in the month of August with August options based on the September futures. With the futures at 1678, I'm going to sell the out-of-money 1700 call with a 37 delta. I will sell a 1660 put with a delta very comparable. So that is a short strangle that looks like this. And then I'm going to put on a long strangle in the deferred month of September, 1 month further away. And I'm going to choose the 1775 call with a delta of 13. And then I will choose the 1550 put, so that now we have a 4-legged position, a long deferred month strangle in September, a short closer in strangle in August. That gives us a neutral position with positive theta and a negative vega. Let's look at the graph of this. And I'll change the scaling to 10 points on the x-axis. This would be a strangle swap that, like the other positions, earns positive time decay, positive theta. It does have a volatility component, in this case minus 40. $40 of impact for a 1 percentage point change in IV. $40 of profit if implied drops by 1 percentage point. $40 of loss if implied goes up by 1 percentage point. As I look at the different timelines, you will see that the beta becomes greater, which is good. The vega becomes smaller. After 25 days at this current level, the vega component is almost non-existent. It's only $2, which means you don't really care whether implied volatility is going up or down. It doesn't affect the trade. What affects it is the profits that you've built up from positive time decay. But you can't really look to the future. You always have to look at the present and make your assessment right now, because as the market moves right now, if we have a continuation of this rally that we're seeing in the stock market, you can see that our deltas, which are neutral starting out, become negative on the way up, and we start to lose money. Our vega factor which was negative 40, now is negative 23. Most of you probably know that when the stock market rallies, implied volatility tends to come down, so that's not a bad thing. But we certainly don't want this rally to continue too much because our losses would certainly grow beyond this small $125 loss if the market continues up. So you as a trader would want to set what I call a trigger level, and if your trigger level was, like, let's say at 1700 to make an adjustment for your deltas, you would need to obtain positive deltas, positive 15 deltas in this case. So how do you get positive deltas without sacrificing positive time decay? You do a credit put spread. So if the market's at 1700 and we want to obtain positive deltas from a credit put spread, what we could do is buy to close a 1660 put and sell to open a put with a higher strike price, something like the 1690 put. So when you buy the 1660 put and sell the 1690 put, you're collecting a credit, you're getting positive deltas, and let's see what that does to the graph. It happens to get us almost perfectly neutral again. So we have shifted the picture that we're looking at to the right so that now on the T+0 line, we're sitting near the apex, near the peak of this curve, which means we're delta neutral. And now we're ready to wait to see what the market does. Does it keep going up? Does it turn around and go back down? But the idea is we have eliminated the risk of the market continuing to rally and losing money, losing more money. Now we just have to sit and wait to see how does the market behave at this point. If it stays here for a while and time goes by, we'll start to build up some nice profits. We did make our Vega factor a little bit more negative by doing the credit put spread, because the credit put spread by itself has negative Vega, and that would mean that that negative Vega added on to the negative Vega of the existing position makes our overall newly adjusted position negative Vega a little bit more negative, but not too bad, especially in relation to the beta of $20. So that would be a simple adjustment again, a credit put spread to accommodate the move up in the market. Let's go back to our original position here. And this was our original position. And let's take a look at what happens if the market drops in price. If this market starts to head down and we get a 20-point drop right away, now we are going to have 17 positive deltas. And realistically, our negative Vega factor of -36 is going to hurt us, because we know that implied volatility will rise when the stock market sells off. So if that does increase by 2 percentage points, we can put that in on the left side of the screen here, and it will show us we're going to lose about $182, and our deltas are going to be 15, and we'll continue to lose money at a faster rate if the market keeps dropping. So what we need to do then is make an adjustment to acquire negative deltas to counteract the positive ones that we have, and we may even want to acquire some positive Vega on the adjustment in order to benefit from the anticipated escalation of IV that might occur as the market keeps going down. Maybe we don't even want to get neutral. Maybe we want to get a little bit delta negative. So once again, a perfect strategy to do that, to give you negative deltas and positive Vega, would be a diagonal calendar put spread. Diagonal calendar put spread. So if we go into the month of September, and if we buy a 1660 put, like a close to the money put, and then if we sell, let's say, a 1640 put in August, that is a diagonal calendar put spread. And let's see what that does to our position. It gets our position to be 6 deltas long, not quite as long as it was before, and it gives us a positive Vega factor. So we're on the right track. Let's go ahead then and change the August put from the 1640 to the 1625. So that's really the adjustment we want. We want to sell the 1625 and buy the September 1660. That diagonal calendar put spread will then get our position to be exactly delta neutral with an 18 positive Vega. So we do now benefit a little bit from volatility going up, and we've neutralized our position. You can see that this trade really can start to make some nice profits with the passage of time, but if you really wanted to get more biased to the downside, well then, what we can do in addition to this diagonal calendar put spread, we could do a credit call spread. Because we're going to be spending money on this diagonal calendar spread, now we can collect some cash by doing a credit call spread. We could buy to close that 1700 call that we originally sold. That'll be purchased back at a profit, of course. And we would sell to open, let's say the 1690 call. So that's a credit call spread. And what does our position look like then? Then we're 6 or 7 deltas short with still a very small positive Vega factor. So that does kind of give us a head start if the market keeps going down like another 10 points. Then we're a little bit delta positive, and we may want to review things and see if we need to make an adjustment. The passage of time makes a big difference. I'm always looking at the T+0 line, and you don't want to do the same, because if it turns out that 8 days go by and this is your T+0 line then you'll be 4 deltas long. Your Vega factor will be more positive in your favor. In 17 days, you're going to have 7 deltas long with even a more positive Vega factor. And maybe at that point, you would want to make another delta adjustment. You could do another credit call spread, for example. You could buy to close the 1690 call, and you could sell to open, let's say, the 1675 call. And then you would be 4 deltas short in 17 days, still with a positive Vega factor. So this is a very dynamic environment, and as long as you review your positions every day, look at your Greek variables, and make the vertical credit spread adjustments and or diagonal calendar spread adjustments for your Vega and delta exposure, you will stay on top of the situation. The idea is you always want to be either neutral or slightly biased with deltas in the direction that you feel the market is moving. And you never want to get to the situation where you're in a position where your deltas are too positive on the downside or too negative on the upside, because then you run the risk of incurring fast losses if the market continues to trend against your position. Okay, let's clear these out. And no other questions. I'm a little bit surprised. Feel free to type them in so I can address them for you. So really what I've shown you is you can adjust a butterfly trade, you can adjust a calendar spread trade, you can adjust a strangle swap trade, because these trades are trades that lend themselves to modification in order for you to get your position in sync with what's happening in the market. I do not, as a general rule, adjust directional trades. Here's an example of a directional trade, a bull call spread. Here's what a bull call spread looks like. When you put this trade on, in this case long a close to the money call, short an out of the money call, as the market rallies, you tend to make money as long as it doesn't take too long for the market to rally. Then you happen to lose with the past because it's a negative time decay on the trade. And if the market goes against you, you lose because your deltas are long and they stay long as the market goes down. And this is a trade that I would not want to adjust. It's a trade that I would simply close if the market moved unfavorably and I lost a predetermined amount of money that I did not want to exceed. So in this case, if this trade loses, say, $293 because it drops 20 points in one day, or if it loses the same amount of money if it drops to 1663 in 8 days, that would be my trigger level in 8 days. I prefer to simply close directional trades that go against me because there's no easy way to adjust this to compensate for the losses. This trade's performance is a function primarily of the delta bias. A directional trade has usually a higher delta on it, and so its performance is largely a function of whether the market moves in your favor or against you. The volatility component is a very small part of it. The negative time decay is a small part of it. It's the directional move that either works for you or against you. It's just like a futures trader. If you put on a long futures position and it goes up, you take your profit, and then you decide what you want to do at that point. Maybe you want to go short. If you put on a long futures and the market goes against you and you have a loss, you buy it back before the loss gets too big. Or I should say you sell it. You sell it before the loss gets too big. Or you put in a sell stop to keep your loss from growing too large. But there's really nothing that you want to do in the way of adjusting. You just take your profit or take your loss. That's an example of a directional trade. Another directional trade is the opposite, a credit spread, like a credit call spread. Same thing. This trade tends to make money with the passage of time. It makes money as the market goes down. So it's just a question of when you want to take your profit. But however, if the market goes against you and the losses are growing, they're growing primarily because your negative deltas are hurting you. And there's no easy way of adjusting this trade to try to compensate for that amount of loss because the Vega factor is very small. The positive time decay is very small or non-existent depending on how high it goes. So that's why, as a general rule, directional trades like vertical call spreads or vertical put spreads are great positions to use for adjustments, but they are not positions that if you start out with, you don't want to adjust them at all. You just want to take them off. So really what we're talking about is we have a toolbox, or we have a whole bunch of weapons at our disposal or tools at our disposal. Vertical spreads are great tools to use for modifying positions that you have, which are volatility-based trades. But vertical spreads like this, being directional trades, are trades that if you put them on as initial positions, you simply take them off, favorable or unfavorable. Now, there are other positions that I myself are not keen on, things like long strangles or long straddles. Here would be an example of a long strangle, buying a 40 delta 1710 call, buying a 40 delta 1665 put. This is a position that is adjustable because it does have a large volatility component, and it allows you to adjust for profits on the way up. It allows you to adjust for profits on the way down. However, it's a type of a trade that loses with the passage of time, so it's not a trade that I would even establish myself. But if you are the type of trader that wants to play for large market moves in a short period of time, then you certainly can use the adjustment methodology that we've been talking about in reverse. Because in this case, it's good when the market moves up or down, because when the market moves up, your deltas get positive. If implied volatility moves in your favor, you generate profits. And in order to not give the market a chance to take those profits away from you if it reverses direction, you would want to adjust a trade of this sort by getting your deltas back to neutral. And you may also want to do something about the large positive Vega factor that you've benefited from. But just looking at it from the standpoint of adjusting your deltas, you would say, how do I get 24 negative deltas? Well, we do a credit call spread. You could take profits on your 1710 call by selling it, and then you could purchase a out-of-the-money 1750 call. So that's a credit call spread that locks in profits on the call that you're selling. And now at this level, you are getting close to delta neutral, and you are reducing your negative theta by about $5 a day by doing that credit call spread, and you're reducing your Vega exposure just a little bit by doing that credit call spread. So the difference here is you're adjusting to lock in profits, and you're doing that with the same vertical spreads. You're adjusting in the direction that the market is moving. Or I should say you're adjusting opposite to the direction the market is moving, because your deltas were growing increasingly positive, so now you need to acquire negative deltas. You need to adjust in the opposite direction that the market is moving. The market's moving up, you need to get negative deltas in order to balance your position. The reason I'm really not spending much time on these types of positions is because these are long premium negative time decay spreads that I personally do not favor. I much prefer positive time decay spreads that are biased in the direction that I desire, whether that be neutral, bearish, or bullish. So that's the difference. But long strangles can certainly be adjusted using the same methodology with vertical spreads. And if you instead wanted to adjust not only your deltas, but you wanted to reduce your Vega exposure in a case like this, then what you would do is the following. Let's go back to the position that we had, which was the 1710 and the 1665 put. So here we are like this. Now the market rallies up, and let's say now we want to acquire 25 negative deltas, and we'd like to get some negative Vega. So what is the type of a trade that gives us negative delta and negative Vega? Negative delta and negative Vega. Well, this is a position that would be called a reverse diagonal calendar spread with calls. A reverse diagonal calendar spread with calls. So that means we would be purchasing a call in the month of September, and we'd be selling a call in October. And we want to do that for negative deltas. So if the market rallied up to, we said, 1710, if we were to sell the 1710 in October, and if we were to purchase the 1750 in September, that spread, long the out-of-the-money 1750 in September, short the at-the-money October 1710, is going to give us the negative deltas almost that we're looking for. We're down to positive 9 deltas now on the spread. We have reduced our Vega to 236. So that accomplishes a couple of things. It reduces our exposure to giving back profits if the market declines. We're still going to be a little bit with 9 deltas making profits on the way up, but we have acquired with this spread by itself negative deltas and negative Vega. So you could do a reverse diagonal calendar spread with calls to accomplish that. You're adding to the position that you've got, but you are massaging your Greek variables to get to where you want to be. This is your instrument panel, the delta, the gamma, the theta, the Vega. That really is what you want to focus on in relation to the T+0 line whenever you are working with spreads. All right, let's see here. Okay, a couple of questions. Do you have any guideline as to increased or decreased exposure to risk with each adjustment considered? Well, certainly the idea of adjusting is you are reducing your risk by calibrating your delta and your volatility to be within your range of comfort. It was the move in the market on these positive time decay trades that I showed you that caused the position to become unbalanced from a delta and volatility standpoint. So by making the adjustment to get closer to delta neutral and to possibly reduce the Vega exposure, that will definitely keep the margins manageable. So as far as guidelines, it simply is a matter of looking at how much money you are losing when the market moves a certain degree, and then having that level in mind so that it triggers you into making your adjustment. It's really monitoring it from a delta standpoint. Another question here, if your theta is the same as your delta, in other words, if theta is plus 100 or minus 100, do you still try to get delta neutral? Well, to my mind, if the theta is 100 and the delta is, let's see, let me make sure I understood that. If the theta is the same as your delta, you still try to get delta neutral? Yes, definitely. The theta of $100 a day is very, very small in relation to your delta being unbalanced by 100. You don't even want to look at theta in relation to delta. If anything, you want to look at theta in relation to Vega, because those are two dollar amounts that you can relate to one another, theta and Vega. The delta is completely separate. If you have 100 deltas unbalanced, that's the equivalent of a futures contract. That's way too many deltas for most people. So you want to make an adjustment long before that happens. Now, if you happen to be a trader that's working with a huge amount of money, maybe 100 deltas is rather small in relation to the entire position. In that case, you can simply adjust your deltas with futures, or you can make options adjustments to compensate for them, but do not compare theta with delta. You want to keep those separate in your mind. Can iron condors be adjusted similar to the iron butterfly? Yes, absolutely. Iron condors and iron butterflies, or regular condors and regular butterflies, can all be adjusted in the very same way with vertical spreads to modify the deltas, or with diagonal calendar spreads to modify volatility in addition to deltas. Do the same techniques apply to iron condors as those used for iron butterflies? Yeah, that's exactly the same question. Same techniques can be used for iron condors as with iron butterflies. So, for example, if we had an iron condor in the let's see, the E-mini S&P, if I were to put on an iron condor, that would be, for example, selling the 1710 call with 24 deltas, selling the 1635 put with, those are out of the money puts and calls. You have a short strangle, and then the iron condor means that we would be hedging that with like the 1750 call and the, let's say, 1610 put. That would be an iron condor, a little bit unbalanced, you know, 6 deltas short, but same principles apply. On the way up, when the deltas get negative, you would do a credit put spread to get the deltas back to balance. On the way down, when the deltas get increasingly long, especially with time, you can do a credit call spread to get the position back to balanced. And I've given you examples with iron condors and iron butterflies, but the traditional butterfly, which would be, for example, all with calls or all with puts. So if we have the body of the call butterfly at the 1680 level, if we've got the 1640 wing 40 points away, and then we go 40 points away on the upside, and we have the wing at the 1720 level, this is a traditional call butterfly. Same thing works here. As the market rallies and the position becomes delta short, we need to get positive deltas. So we can do that by putting on a credit put spread, So if we sell, for example, the 1650 put, and if we buy, let's say, the 1625 put, that gives us positive deltas, and that would get us to being delta neutral on this trade. And so now we have not only a call butterfly, but we have a call butterfly as well as a credit put spread. You've sort of increased the number of options you're working with, but it doesn't really matter. What matters is how you are adjusting your Greek variables to reduce that exposure from a directional standpoint. You want to reduce the possibility of incurring more losses if the market continues to trend. Okay, let's see what else we have here. All right, well, the one thing I would also like to share with you folks is that, yes, this webinar will be available to view again. You can go to the OptionVue.com website and click on View Archived Webinars, and you will find this one. It will be posted. It will be on adjusting options positions. Then, if you have questions after doing that, you can contact me through email. This is my email address, owl@west.net. And in addition, I have a website. There it is in the chat window, theaceprogram.com. I've got a lot of free webinars for you to listen to, about 25 hours actually. I also have a lot of other educational material that I do sell, so you can take a look at what's available. And I, in addition, do offer mentoring. So feel free to check out what's available on the website. There is, as Jim put on here, a large webinar this Thursday with Len Yates. And he's going to go into an explanation on something that's quite exciting. It's the new horizontal skew model. It's going to be soon to be released in version 7.3. You can sign up for that webinar on the front page of the OptionVue.com website. This is a major enhancement to the program. It's going to be the most sophisticated modeling for calendar spreads, and diagonal calendar spreads. And I do not believe there are any other software programs on the market that really are going to have anything similar to the sophistication that this is going to be. It's going to be a really nice enhancement to the program. Let's see, another question here. Do I consider increasing my risk when I do the adjustment? Well, I don't like to increase risk when I'm making an adjustment because the only reason for the adjustment in the first place is that the market is behaving in such a way that I'm probably losing some money. And in that case, I want to make a risk-averse adjustment. I want to keep my risk at the same level or lower than what it was originally so that I'll have an opportunity to make back the loss and become profitable without increasing my exposure. If you were to add to your position by selling more option premium, building the position size, then that would tend to make your margin increase. It would tend to give you more positive time decay, and all of that may work out well, but unless you started with a position that was rather small with the intention of adding to it over time, then I tend to shy away from increasing the risk of my position by building its position size. Let's see. When you do your adjustments, it costs money. How do you make money with the credit spreads? Well, when we do these adjustments, credit spreads with calls, credit spreads with puts, it really does not cost money. It actually creates a credit. It adds money to your account at the same time that it is neutralizing or reducing your delta exposure. So credit spreads make money because they earn positive time decay. And when they're done properly so that they reduce your overall bias on your existing position, they're also reducing your risk. Okay, folks, I think that pretty much does it, and I very much thank you for attending and look forward to future webinars with you.